There are moments in the market when the noise becomes overwhelming, screens flashing, opinions colliding, emotions rising like a storm that threatens to pull the trader under. Yet in those very moments, buried beneath the chaos, lies a rare and powerful truth. The only constant in the market is human behavior. Prices evolve, technology advances, and news cycles accelerate. But the psychology driving speculation has remained the same for more than a century. And it is within this psychology, within the inner discipline of the trader, that true mastery begins. Before we dive into principles, strategies, or techniques, let me give you the emotional hook that every serious market participant eventually confronts. Your greatest wins and your most devastating losses will never come from the market. They will come from yourself. Not from the trend, not from the chart, not even from the system you follow. They come from the battle inside your own mind: fear, impatience, hesitation, ego, greed, doubt, and reckless confidence. This video is about mastering that battle. And to do that, we begin with timeless core principles that have shaped profitable speculation for generations. Principles based not on prediction, but on understanding the rhythm of the market and the discipline required to ride that rhythm with composure. But before we continue, if you're serious about building your mindset, sharpening your discipline, and learning how true operators think, pause for a moment and hit the subscribe button. It supports the channel and ensures you never miss another lesson on professional, level trading psychology and trend following strategy. Now, let's get into the heart of the matter. One of the first truths in speculation is the painful realization that most of our decisions are emotional triggers disguised as analysis. A rising price seduces even cautious traders into believing they're missing out. A small pullback convinces them the trend has ended. A string of wins inflates confidence beyond rationality, and a string of losses destroys conviction when conviction is needed most. This is why any set of principles that has survived decades must begin with self-control. A trader without emotional discipline is like a ship without ballast. One strong wave and it capsizes. The market doesn't need to defeat you. You defeat yourself long before price does the job. The disciplined operator understands a simple but counterintuitive truth: waiting is a position. Patience is not the absence of activity, it is the presence of control. Most traders lose because they cannot wait for the market to reveal its intention. They crave action, they crave confirmation, they crave certainty. But the market provides none of these on demand. It gives clues, not guarantees. Probabilities, not promises. And the trader who respects this uncertainty gains a powerful advantage. Another foundational principle is the recognition that the market is always right. Your opinion is not. This mindset liberates the trader from the need to be correct. When ego dissolves, clarity emerges. Instead of trying to outsmart the market, the disciplined speculator allows the market to lead. Trend following is not prediction, it is alignment. You don't impose your logic on price, you let price reveal its truth. This section sets the stage for everything that follows. These timeless principles are not strategies, they are psychological frameworks. They prepare the trader's mind for what the market will demand: patience, emotional restraint, risk awareness, and the humility to accept that survival precedes victory. In the next section, we'll go deeper into reading early trend behavior, interpreting price action through a psychological lens, and recognizing the signals that separate noise from opportunity. Every major trend begins quietly. There is no trumpet, no headline, no flashing alert announcing that a profitable movement is about to unfold. Instead, it starts with subtle shifts, tiny imbalances between supply and demand, barely noticeable to the impatient trader but unmistakably clear to the disciplined observer. The market always whispers before it speaks, and it speaks long before it roars. The task of a serious speculator is to develop the patience and the emotional stillness, to hear that whisper. To read these early signals, we must first understand that price itself is the purest expression of market psychology. Indicators lag, opinions distort, predictions seduce. But price, stripped of interpretation, reveals the true emotional temperature of the crowd. Fear, confidence, hesitation, and aggression all leave fingerprints on the chart. The disciplined trader learns to interpret them without projecting personal expectation. One of the earliest signs of a potential trend shift is a change in character. This doesn't mean a dramatic breakout. It means something quieter, a previous series of lower highs suddenly flattening, a downtrend beginning to lose its momentum, buying pressure appearing where previously there was none. These small changes in rhythm signal that the tug of war between buyers and sellers is shifting. To the untrained eye, it looks like noise. To the prepared trader, it is the first hint of opportunity. But recognizing these hints requires a foundation of emotional neutrality. A trader controlled by impatience will enter too early, mistaking every minor uptick for the start of a major move. A trader controlled by fear will hesitate, waiting for absolute confirmation that never comes. Both are victims of the same internal enemy, emotion masquerading as logic. This is where discipline intersects with survival. You must learn to observe without participating immediately. The early signals of a trend are not invitations. They are warnings. Be alert closely. But don't step forward until the market reveals enough structure to justify the risk. Another early clue is the behavior of volume during transitions. Rising volume near key turning points often indicates that stronger hands are quietly positioning themselves. They do not chase. They do not act impulsively. They accumulate or distribute with patience and control. Their activity creates footprints in the data. The disciplined trader watches for these footprints, not to predict the future, but to align with the shift once the trend confirms itself. Trend reading is as much an internal skill as it is an analytical one. You must train yourself to separate motion from meaning. A market can move sharply without changing its underlying trend. Likewise, it can appear flat while preparing for a powerful breakout. The amateur reacts to movement. The professional interprets structure. Structure is what reveals intention, and yet, even the most beautifully forming trend is meaningless without one more component: risk control. Early trend signals can be intoxicating. They stir excitement, confidence, and hope. But hope is not a methodology. Risk management grounds the trader in reality. You never commit fully based on an early signal. You scale, you test, you probe the market with small positions that allow you to survive being wrong. A trend is not validated by what you feel. It is validated by what price proves. Patience is your shield here. Many traders ruin themselves by trying to anticipate a trend rather than waiting for confirmation. They jump too early, take full-sized positions, and then panic when the market does what it always does: test conviction. The disciplined speculator knows that uncertainty is not a threat. It is part of the landscape. By controlling exposure and waiting for structural confirmation, you remain calm while others get shaken out. Trend following begins not with prediction, but with awareness, with observation, with the quiet acceptance that the market will reveal its intention in its own time, not yours. The early signs of a trend are invaluable, but only to the trader who has mastered the patience to wait and the discipline to act only when probabilities shift decisively in their favor. In the next section, we will dive deeper into the psychology of holding a winning position, why most traders sabotage themselves, and how disciplined operators stay aligned with the trend long after others have exited. Catching the beginning of a trend takes awareness, but profiting from a trend, truly extracting its potential, requires something far more difficult: the discipline to hold. Most traders can enter. Most traders can exit. But very few can stay with a winning position long enough to allow the market to reward their patience. And it is not lack of intelligence that stops them. It is lack of emotional control. The moment a position moves into profit, an internal conflict begins. The trader feels both relief and fear: relief that the trade has worked, and fear that the gains could vanish. This fear creates a deceptive temptation. Take the small profit now and protect the win. It feels safe. It feels rational. But it is one of the greatest psychological traps in speculation. Why? Because small gains cannot compensate for inevitable losses. A trader who cuts winners short and lets fear dictate exits will always remain behind the curve. The market's biggest opportunities are rare, and when they appear, the disciplined operator must be willing to let them run. Not out of recklessness, but out of respect for probability. A strong trend, once underway, is a force far greater than any single decision. It offers asymmetric opportunity, limited downside if risk is controlled, and potentially extraordinary upside if patience is maintained. Holding a winner is not passive. It is a deliberate, controlled act of self-regulation. Every pullback tests conviction. Every consolidation tests emotional stability. Every late entry surge from other traders tests your ability not to overthink what you already did correctly. The disciplined operator understands that the trend, not the trader, does the heavy lifting. Once aligned, the task becomes simple: stay out of the trend's way. But simplicity does not equal ease. To hold a winner requires recognizing and overcoming several psychological barriers. 1. The urge to secure certainty. Profits create emotional pressure. The mind tries to convert floating gains into realized certainty. This impulse must be resisted. The trader must prioritize strategic thinking over emotional comfort. 2. The illusion of a perfect exit. Many traders exit early because they fear missing the top. But trying to capture the absolute high is a form of greed disguised as precision. The disciplined speculator aims to ride the major movement, not to predict the endpoint. 3. The distraction of noise. During a trend, small retracements create anxiety, but a mature trend breathes, it inhales and exhales. Those who mistake normal volatility for reversal sabotage their own success. The operator reads structure, not emotion. 4. The belief that profits must be protected at the first sign of weakness. Weakness within a strong trend is not a threat, it is the trend gathering energy. The operator distinguishes between structural deterioration and ordinary fluctuation. This entire process requires emotional neutrality. When you're in a winning trade, your job is not to celebrate or fear losing the gain. It is to monitor the trend with clarity and discipline. Ask yourself, has the character of the trend changed? Has the market violated the levels that define its structure? Is my risk still controlled? If the answers support continuation, then you continue, not emotionally, methodically. A disciplined speculator uses trailing stops, scaling strategies, and structured exit rules, not gut feelings, to maintain alignment while protecting capital. This removes emotional noise and keeps the trader focused on the one truth that matters: a strong trend will continue further than most participants believe possible. By holding with discipline, you position yourself to capture the outsized moves that define long-term profitability. One great trend can outweigh months of ordinary results, but only for the trader who has mastered the inner battle. In the next section, we will explore the equally challenging skill of losing well, how professional operators manage losses, protect capital, and cultivate resilience while others spiral into emotional escalation. Every trader enters the market with dreams of large profits, but very few prepare for the reality that losses are unavoidable. Not occasional, not rare, unavoidable. The difference between a market survivor and a market casualty is not who avoids losses. It is who handles them with clarity, discipline, and emotional stability. Most traders lose twice when they take a loss. They lose capital, and then they lose psychological control. They become frustrated, reactive, stubborn, or reckless. They take revenge trades, increase position sizes without logic, or jump impulsively into setups that don't deserve their capital. The loss becomes more than a financial event. It becomes a mental spiral. But the disciplined operator treats a loss like a routine business expense. It is part of the cost of operating in an uncertain environment. There is no dramatic meaning attached to it, no self-judgment, no emotional story playing. The market is not punishing them, nor are they wrong in any personal sense. They are simply paying the price of participation. A true professional views losses through a different lens. 1. Losses are information. Each loss reveals something: a shift in trend, a weakness in timing, or a failure of market structure. Losses are not verdicts. They are feedback. Professionals read this feedback with curiosity, not fear. 2. Losses are protection. A properly executed stop loss prevents a small setback from becoming a catastrophic event. The undisciplined trader clings to hope, and hope is the most expensive emotion in the market. The professional accepts reality quickly, protects capital, and lives to fight another day. 3. Losses maintain emotional neutrality. Taking a small, controlled loss keeps the operator psychologically centered. It prevents the buildup of stress, regret, or panic. It keeps the mind calm enough to recognize new opportunities without emotional distortion. To lose well requires 2 fundamental commitments. First, absolute clarity about where you are wrong. Before entering a trade, the disciplined operator already knows the exact price level that invalidates the setup. This line is objective, structural, and impersonal. There is no negotiation with it. When the market reaches it, the position is closed, immediately, cleanly, without debate. Second, the willingness to honor that line every time. Most traders know where they are wrong but fail to act on it. They freeze. They bargain. They wait for just one more bounce. This hesitation transforms a manageable loss into a serious wound. The professional operator does not hesitate. They execute their exit as soon as the structure is violated, not because they enjoy losing, but because they understand the cost of failing to do so. The disciplined trader also understands the importance of staying small enough to remain calm. Oversized positions destroy judgment. They provoke fear, anxiety, and emotional imbalance. Risk must always be sized in a way that allows the trader to think clearly, respond rationally, and remain objective under pressure. There is a profound paradox in speculation. The operator who is most willing to accept small losses is the one who stays alive long enough to capture large gains. The trader who fears small losses invites catastrophic ones. Mastering loss taking is not merely a tactical skill. It is the foundation of all long-term success. It cultivates humility, resilience, and the steady mindset required to navigate uncertain environments. Losing well does not mean losing often. It means losing correctly, cleanly, efficiently, and without emotional disturbance. With this discipline, the operator maintains a strong psychological foundation, a clear strategic lens, and a robust account capable of supporting the next opportunity. In the next section, we will explore how the disciplined trader ties everything together. Reading trends, managing risk, cultivating emotional control, and developing a method that stands the test of time. At this stage, the disciplined operator understands that successful speculation is not built upon a single technique, indicator, or market trick. It is built upon a cohesive internal and external framework, a way of thinking, acting, and responding that remains stable regardless of what the market does. True mastery emerges when psychology, risk control, trend, reading, and patience are fused into one unified method. To integrate these principles, the trader must first recognize that the market is an environment of constant uncertainty. There are no guarantees, no perfect signals, and no strategies that work without fail. The undisciplined trader tries to eliminate uncertainty. The disciplined operator learns to function inside it. They see uncertainty not as a threat, but as the natural condition through which opportunity emerges. This acceptance removes emotional friction. It frees the mind to observe, analyze, and execute without the burden of unrealistic expectations. The core of this framework is trend recognition. Trends are not opinions. They are visible expressions of crowd behavior. When a trend strengthens, it reveals that buyers or sellers are dominating. When a trend weakens, it reveals hesitation or exhaustion. The disciplined operator studies these dynamics with patience, waiting for moments when the balance clearly shifts in one direction. These are the only moments worthy of commitment. Everything else is noise. Once in a position, the trader brings risk control to the forefront. They know their exit point in advance. They know the size that keeps them rational. They know the structure that invalidates their idea. And they honor these boundaries with unwavering discipline. Risk control is not a constraint on ambition. It is the foundation that protects ambition from self-destruction. Then comes the psychological element, the internal governance system that separates elite performers from the crowd. A disciplined trader controls their impulses, the urge to overtrade, to chase, to react emotionally, to force outcomes. They understand that the market rewards clarity, not excitement. They know that patience is not waiting aimlessly. It is waiting intentionally, with purpose and alignment. This mental fortitude allows them to hold winners long enough for the trend to unfold. They stop looking at the market as a series of random events and begin to see it as a landscape shaped by human emotion. Fear, greed, hope, disbelief. The disciplined operator positions themselves outside this emotional storm and observes it objectively. They are not swayed by crowd euphoria or shaken by crowd panic. They follow their structure, not the noise. When losses occur, they treat them as structural data rather than emotional wounds. When gains appear, they treat them as the byproduct of disciplined execution, not personal brilliance. This humility preserves mental balance. It prevents overconfidence and protects the operator from the destructive behaviors that often follow periods of success. Over time, the trader develops a rare internal steadiness, a calm confidence that does not depend on the outcome of any single trade. This stability becomes a superpower. It allows the trader to execute consistently through different market cycles. It allows them to refine their method rather than reinvent it impulsively. And ultimately, it allows them to stay in the game long enough to catch the big opportunities that define a career. The true hallmark of mastery is not brilliance. It is consistency. Not prediction, but preparation. Not excitement, but discipline. The trader who internalizes these principles begins to understand a powerful truth: when you control yourself, you gain leverage over the market, not by dominating it, but by aligning with it. And in that alignment lies the potential for exceptional, enduring results. If you found value in these principles and want to continue sharpening your mindset, discipline, and strategic approach to markets, make sure you like, comment, and subscribe for more deep market psychology and trend following insights. Your journey as a disciplined operator is just beginning. Stay focused, stay patient, stay in control, and as always, trade with clarity and purpose.